Most people think being wealthy is about earning a high income. But income is only half of the story. Two people can earn the same amount and end up in completely different financial situations after 20 years. The difference often comes down to one simple idea: assets and liabilities. Once you understand how each one quietly shapes your future, your financial decisions start to look very different from day one. At its core, an asset is something that puts money into your pocket over time, either by growing in value or by paying you regularly. A liability is something that takes money out of your pocket over time, either through payments, maintenance, or interest. The labels are not about how something looks. They are about how it actually behaves financially in your life. This matters because many people unknowingly fill their lives with things that look successful but quietly drain money. A fancy car, an oversized home, an expensive lifestyle. These can be liabilities even if they impress others. Meanwhile, true assets are often quiet, boring, and invisible to outsiders. Wealth is built less by what you display and more by what you actually own that produces real returns. To understand how it really works, think of every purchase as a future cash flow question. Will this thing pay me back over time, or will it cost me regularly? A stock that pays dividends, a rental property that produces income, or a business that generates profit are clear examples of assets. A car loan, a credit card balance, and luxury subscriptions are clear examples of liabilities. Let us look at a simple example. Imagine two people earning the same income. One buys a modest home and invests in quiet, diversified funds every month. The other upgrades to an expensive car, takes on a large mortgage, and finances a high lifestyle. After 20 years, the first person owns assets that pay them back. The second person still owes on items that have lost value. Same income, different outcomes. A common mistake is to call something an asset just because you own it. A car bought purely for transportation usually loses value, requires fuel, and demands maintenance. Even if it sits in your name on paper, it behaves like a liability in your life. True classification depends on the long-term cash flow. The way something feels emotionally is rarely the same as the way it actually works financially. There is also a hidden risk in confusing the two categories. People can feel rich because of the things they have while quietly going broke from the things those items cost to maintain. Income is what comes in. Wealth is what is left after liabilities take their share. A high income with high liabilities can produce far less real wealth than a modest income with very few liabilities and steady assets. A useful way to picture this is as two opposite teams pulling on your wallet. The asset team pulls money toward you over time. The liability team pulls money away from you over time. Every financial decision either adds a player to one team or the other. Building wealth is not about earning more. It is about quietly shifting the balance between these two teams in your favor. A second key idea is that some items can be either, depending on how they are used. A home can be a liability if it stretches your budget, demands constant repairs, and never produces income. The same home can lean toward an asset if part of it is rented out, if it is paid off well before retirement, or if it appreciates significantly. Context shapes the label more than the object itself. A practical example helps. Imagine someone buys a business they run themselves. While it produces income, it is an asset. The day they stop running it, if it cannot operate without them, the picture changes. A true long-term asset usually produces value with or without your daily effort. A high-paying job is wonderful. But if income stops when you stop, it functions more like temporary cash flow than a lasting asset. Beginners often misunderstand how slow real asset building can be. Movies make wealth look fast. Influencers show only the result, not the years of quiet contributions. But assets are usually built one small purchase at a time, one steady investment at a time, one careful business decision at a time. The slow nature of real wealth is exactly what makes it durable. Quick wealth is often quick to disappear too. There is also a psychology angle. Buying liabilities is emotionally rewarding right now. They look impressive, feel exciting, and bring instant comfort. Buying assets is emotionally slower. The reward is not visible today. It is hidden in the future. Wealth often goes to people who can delay the rewards of liabilities long enough to build the quiet rewards of assets. The patience is not about money. It is about emotion. A simple practical rule helps reshape your decisions. Before any major purchase, ask one question. Over the next 10 years, will this put more money in my pocket than it takes out? If yes, it leans toward an asset. If no, it leans toward a liability. Liabilities are not forbidden. You will buy them sometimes. But knowing what you are buying makes every decision more honest with yourself. There are things to avoid. Do not mistake an upgraded lifestyle for actual wealth. Do not fall for the idea that all big purchases are investments. Do not stretch your budget to look richer than you are. Do not buy assets you do not understand just because they sound impressive. And do not let social pressure decide how you classify the things in your life. The math is what matters. A better habit is to regularly review your personal balance sheet. List what you own that puts money in your pocket. List what you owe or maintain that takes money out. The difference is your real financial position. Doing this once or twice a year quietly changes behavior. You start adding assets and slowing the accumulation of liabilities, almost without effort, because you can see what is actually happening. Over the long term, the slow shift between these two categories becomes the difference between financial freedom and lifelong financial pressure. Each year, a small group of new assets grows in size. Each year, the load of liabilities shrinks. After a decade or two, the asset team is doing significant work in the background. Eventually, the income from assets can rival or exceed the income from work. So here is the short version. Assets put money into your pocket over time. Liabilities take money out. Income is not the same as wealth. Many things that look like success are quiet liabilities. Many things that feel boring are powerful long-term assets. Building wealth is not about earning more in a single year. It is about quietly shifting the balance between these two categories across many years. If you want to become financially strong, learn to recognize what is truly an asset and what is truly a liability in your own life. Add assets steadily, even in small amounts. Reduce unnecessary liabilities patiently. Do not be fooled by appearances, including your own pride. The honest math, repeated calmly over many years, is what quietly separates those who reach financial freedom from those who simply look successful for a while.